Hi, Jonathan, your Bay Financial Partners, looking at investment markets. Really, obviously, Ukraine and Fed Chair Powell's recent testimony really dominating the markets at present. So Fed Powell was quite interesting in his comments. He sort of came out and said that inflation was too high, which sort of most economists and analysts sort of have already accepted. But then what was interesting was the other comments that sort of accompanied that sort of statement, in the fact that the Fed was prepared to act potentially more aggressively, would take rates potentially above the neutral rate. But more importantly, if necessary, the Fed would be prepared to move by 50 basis points rather than 25. So let's see the 10-year spike now to around 225 on the yield. Although he did also come out and say that the US economy is certainly in pretty good shape. You got record low unemployment, and really is looking at sort of pushing on at a pretty good rate. And certainly with the US economy as well, remember there's still a lot of pent-up demand, some pretty high savings rates, and as the economy does sort of reopen, there's potential out there for the US consumer that does have a lot of money to be able to go out and spend it. However, there was some sort of potential impact from the Ukraine crisis, but as yet, though, it is really too early to sort of see what that full impact will be. Now, on Ukraine, sort of President Putin is becoming more sort of desperate by the day, really, now dragging into the third week. Really thought this was going to be a pretty quick sort of exercise. It's still quite interesting that he still refers to it as special military operations and not a war. But again, he's becoming increasingly isolated, and it's really, really pretty horrific, some of the events that are taking place in Ukraine at present. All of them strenuously denied by the Russians, but you only have to look at the sort of newsreels to see what's going on. And the real problem is now that Putin sort of backed himself into a corner, and like I say, it's getting more embarrassing, and the longer it sort of drags on, and it's hard to see how he's going to come out of this and sort of save any face. Because at present it looks a pretty unmitigated disaster. Although it appears that Russia did manage to avoid a debt default last week with some interest payments, but again, sort of looking forward, that's going to be pretty hard to maintain. Oil has spiked above $100 now. It's currently trading around 110 on WTI, and that's on potential worries about sort of supply issues going forward. Now in the UK, again, UK economy is sort of pushing on at a pretty good rate, and again, Prime Minister Johnson has managed to avoid the sort of domestic local flack he was facing with the Ukraine crisis sort of coming up, and really sort of devoting all his attention to that. Now, obviously, the EU and the UK sort of facing a bit of a refugee crisis, really, as people sort of streaming out of Ukraine. Potentially around 10 million people have left the country in the last couple of weeks. Now, in the midst of this, obviously, you've still got COVID in the UK and Europe. But interestingly, Germany is sort of looking at relaxing its restrictions on the sort of COVID front. So it's just going to be very interesting to see how that sort of plays through, to see if you do get a big spike in cases. And all the time, obviously, you've still got inflationary pressures in the EU region. And I say you've still got a central bank that is still on a quantitative easing program. The Australian economy, with the borders open now, is starting to look to sort of pick up over the next sort of 6 to 9 months. Clearly benefiting from the boom in commodity prices and resources at present. With that pent-up demand in Australia, the Australian economy really does look in pretty good shape. Here in New Zealand, expecting potential sort of relaxations of COVID restrictions again, but that sort of comes against the advice of some of the experts that are still saying that, given COVID is still sort of pretty rampant in the community, now is not the time to be relaxing. The issue is that the government's sort of facing increased pressure really on all fronts, because certainly the latest consumer confidence numbers really are pretty weak. These levels were last seen in the GFC. So when you add that sort of low consumer confidence to potentially sort of rising mortgage rates, and the recent polls and the government sort of falling quite dramatically in the polls, it's just going to be interesting to see what's coming through. Because certainly some of the experts on the COVID front are sort of indicating that the decisions are being made politically rather than on sort of economic or health reasons. And again, in that fixed interest space, there's a further bond out there, IAG, have a 6-year bond. Indicative rate on that is going to be around sort of 5.15 to 5.20. If you're interested in that, go to the website www.bayfinancialpartners.co.nz. So as bond rates are starting to sort of creep up, as interest rates do sort of look to rise, those of you who are looking for income, there are plenty of alternatives available. And if you're interested in discussing what is available, go to the website www.bayfinancialpartners.co.nz for lots of interesting articles, and we look forward to speaking to you soon.